So today's tip of the week is inflation, interest rates, and housing. Oh my. This has been a very interesting since Russia invaded Ukraine, which I think we just, I don't want to say celebrated. What's the opposite of celebrating a year after someone invades another country? We're memorializing, we're crying about, something. So I think once that happened, at the same time, inflation was going bananas, and bananas. That's a technical economic term that Fed Chairman Powell will be explaining at the next Fed meeting. But what we're seeing is that inflation that seems to be incredibly persistent. We're seeing those interest rates that are rising, and it is having a dramatic effect on the housing market, both for single family residential as well as commercial, because one of the exit strategies for commercial is refinancing or selling to someone else who's coming in with their own loan, right? So some of the financials and some of the cash flow is affected by that, by these changes that we've experienced over the last over the last year, really. So inflation is proving to be more difficult to budge than ever. It's been interesting to even watch the stock market or the people who are invested in stocks to how they talk about inflation. So literally like 3, 4, 5 months into we're raising rates, right? The stock market was like, oh, we got this. It's good now. And then it would like go down like from 9.1 to like 8.9. It's like not really any movement, right? And then Fed chairman would come in and do another 75 basis point increase, and then it would come down a little bit. And every time the stock market would be disappointed. And what happened to the stock market today? What happened to the stock market today? Was the stock market a little disappointed today? Yes, it sure was. The Dow was down 1.72%, the S&P down 1.53%, only because somebody had a party. Who had a party today? That'd be Fed Chairman Powell. And no one likes it when he gets in there and says, yeah, we're going to have to get a little bit more aggressive on our interest rate increases. Has he been pretty aggressive so far? I'm going to show you exactly how aggressive he's been. He's probably been one of the most aggressive Fed chairmen that we have had probably since most of us in this room have been around. So those rate increases so far have not affected the economy. What do the jobs look like? What do the jobs numbers look like? They're strong. And what's interesting about them being strong is for the last few months, as the earnings reports have been coming in from some of the larger tech companies, a lot of the larger tech companies are saying we're firing, somewhere between probably around 5%, in some cases a little bit more of their workforce. And those have captured all of the big headlines if you follow or if you're following any of the news. But why isn't unemployment growing? Is because all of these smaller businesses, right, are doing what? Oh, well, I'm so sorry Amazon fired you. How would you like to come and work for me? So these people are getting absorbed almost immediately, right? So those rate increases so far have not affected the economy. Those rate increases so far have not yet affected the jobs market. In fact, I think our unemployment number right now is like 3.4%, which is like a record low unemployment number. I'm seeing, I knew we were in trouble when I passed by the Dairy Queen, and the Dairy Queen had a $500 signing bonus. Now that was about a year ago, right? I'm not seeing $500. Someone's like, I gotta go. I'm not seeing $500 signing bonuses anymore at the Dairy Queen. But that just floored me, right? So a lot of these people are flowing back into work that they were in pre-March of 2020, right? But what's been so fascinating to note is that we are not in a recession, and Fed Chairman Powell is really trying hard to get us there. I think if we all make a pact in this room to stop buying eggs and just stop spending, we could actually help the housing market, actually, because once we stop spending and once we stop seeing those inflation numbers go up, then Fed Chairman Powell's going to take the brakes off of or put the brakes onto his rate increases, right? And that's ultimately what we want to see at the end of the day. But he's I think he's a little emboldened by the fact that our unemployment is still so low. We've got still so many jobs, and he's also probably annoyed, and I think probably everyone in this room is too, that inflation is still relatively high versus where he wants it to be. So the only thing that the interest rates are not improving is inflation, right? But they're hitting some other areas of the market, including us, when it comes to housing. So those interest rates are not responding to those rate increases, at least not the way that the Fed and the markets want it to. So that's something that we're going to continue to have to contend with. And for us in the real estate industry, because about 70% of the houses that are bought on the MLS are bought with financing, right? That's going to continue to have effects on us. So interest rates are increasing at their fastest pace on record. There's been a bigger effect on the stock market than there has been on inflation. What does that mean? The stock market's going down at like in a day, right, at a faster rate than some of these inflation numbers are going down, because when every time they look at the CPI data, the inflation number, and it's still high, the stock market has a little. It's like, oh, you want to invest in the stock market? Here's your defibrillator, right? It comes free, it comes free with it. So whenever they know that Fed Chairman Powell is going to have to raise interest rates again, either increasing the pace and or increasing the rate at which he does it, it has had a big effect on the stock market. So we're seeing that. The next, my projector is not fantastic up here. So, but I do want to go through this with you guys, because I think this is a really important chart, and just kind of give you some relevance of how the interest rate increases are working. So this is the cumulative change in federal funds rate since the start of the initial rate increases. So they track the rate increases that we had in 88, 94, 99, 2015, and that lighter colored one at the very top, that's 2022. So over a 12-month period, we've gone over 4.5 percentage points higher. That's even higher than what we did in 1988. Okay, so it has been dramatic, to say the least, and it's fascinating that that while the inflation numbers don't, there's no correlation, right, between these inflation numbers and these increases. So we'd think it would be like a negative, a negative correlation. There has been certainly a correlation when it comes to housing, but in a little different way than you guys might think. So the housing market is reacting. Sales are down 30% year over year. For some of you guys, I know some of you mentioned that you are realtors, right? Real estate agents or brokers in the room. It probably feels like a light switch. It's gone from on to off, and it feels like it happened overnight. So it feels like it's over the last 6 to 8 months, from the May kind of time frame to obviously where we are today, that we're seeing that big reduction in sales. Now, sales prices year over year, and this is the thing that I think is surprising people, but the surprise, this party is about to be over shortly. Sales prices are up year over year for the same month. So what does that mean? When we look at, when we compare the average sales price and say, well, are we higher or are we lower? We're typically not saying, are we higher than, are we lower than last month? We're typically saying, are we higher or are we lower than this exact same time last year? So if you look at where we are, this exact same time last year, we're actually up, so it's like, okay, well, so a lot of people would read that and say, well, the housing market is not being affected. But the truth is that we've had, where we've had the effect and where it's going to kind of, I think, punch us in the face more than a little bit is, if you look at the June to January numbers, if you look at the June 2022 was the absolute height of our fever pitch for sales prices, the absolute height for our fever pitch in sales prices. So the June, and we typically have a June, to January drop in the sales prices, but usually it's like 3%, right? Just because of the distribution of the way sales happen in the market. So it's very normal. But what we're seeing now, if you look at, for example, Dallas from 537,000 to 469,000, Houston 436,000 to 382,000, San Antonio 401 to 370, Austin 669 to 562, Texas overall 441 to 386. So in some cases that's a 10 to 15% drop, whereas normal is kind of like in a 3 to 5% range. So I think even though all of the National Association of Realtors and all of those folks are reporting solid numbers, it's not affecting house prices, it's still solid versus what it was. Once we get into like the April, May, June comparisons, that's when we're going to say, wow, and I think psychologically, that's going to be a psychological hit that may cause a little bit of may cause some people to, like Fed Chairman Powell, to maybe slow it down a little bit. I think it's going to show up as some really big numbers, some really big deltas. So, but that being said, there were a lot of what I would call paper gains. So in Austin, for example, in 2022 versus 2021, the prices were up, 25 to 29%. I mean, so, it was funny because my husband and I, we were looking at our rental property portfolio. And I remember sitting down with him and saying, I just updated all of, the values of all of our properties. The time that it was that I did this was May of 2022. So at the height of the fever pitch, right? And I said, these numbers just don't feel right. They feel good, but it's almost like that scary movie where the sorority girl is like half dressed and a couple of drinks in her, and she says, I think I'm going to go out to the lake for a swim. And it's like, no, stop, don't go. And like you just know, like, something's really gonna happen wrong here. I don't know exactly how it's gonna happen for her, but it's not gonna be pretty. And I had this moment, and it kind of reminded me of this story, and I have no idea, honestly, if this is true or not, but this story that I heard about Rockefeller. So like 1928, 1929, stock market crash in October of 29, right? Is that right? Who are my historians in the room? It's October 29, right? Yeah. So summer of 29, Rockefeller's getting in the elevator. There's an elevator operator. And for some reason, I don't know, I used to go like this when I'm impersonating an elevator operator, but someone told me, no, you're wrong. It's more like this. So that's right. It's more like this. Okay, I don't know. So, okay. Whatever the movement is. So, and the elevator operator said to Rockefeller, what? What did he say to Rockefeller? Going up. He said, I am making a killing in the stock market. And Rockefeller took a moment to let that sink in, got out of the elevator, and said, let's sell everything. Think about that. Why do you say let's sell everything?
He knew it was too late. If the lower people are buying in, it's already invested too much.
So what's your name? Carlos. So Carlos, this is what Carlos said. I didn't say this. So Carlos said, it's too late. If everyone's getting rich, including the elevator operator, something's just not right. The half-dressed sorority girl is going to the lake by herself, right? Something's bad is about to happen here very shortly. And Warren Buffett has a saying about this. What does he say?
Buy low, sell high.
Buy low, sell high. Yes, he does say that. But what else does he say? What's one of his seven? Don't lose money. That's his rule number one. His rule number two.
He's a value investor.
He's a value investor. He says you should be fearful when others are greedy, and you should be greedy when others are fearful.
Buy when
Right?
the market's down.
Yeah. So,
Protect your principal.
and always protect the principal investment. Yeah. So I'm so glad we got some fellow Warren Buffett fans in here. If you guys are Warren Buffett fans and you want to, so Charlie Munger is Warren Buffett's right hand man for about the last 40 plus years, and there's a book called Poor Charlie's Almanac. It's about a $65 book from Amazon, and it's like, I mean, like you could knock somebody out with it. But it has all of his investing principles in there, and they're all really fantastic. You want to know something interesting about Warren Buffett is that 99% of his wealth came after he turned 65 years old. If Warren Buffett would have retired when most people retire, he would not be the household name that he is today. He would have been an also ran, right? And one of the things that he says is all of the returns in life come from compound interest, like getting in and staying in. So I thought that was remarkable that, and I think, there's a book called The Psychology of Money by Morgan Housel. And in that book, it talks about how this idea, this concept of retirement is only about 2 generations old. That before that, most people were working until they died, right? And if Warren Buffett would have retired at the time that many people retire, right, he would have just been he would have been an also ran, right? He would have not been as memorable as he is today. But there's something going on in the streets, and I will tell you, once we get into May, and once we start comparing the May 2023 versus May 2022, that's, for some of you guys, it's gonna scare you. I will tell you that I've invested through up markets, I've invested through down markets. I've even gotten the honor to invest through the Great Recession without having to go to work for anybody else. So one of the keys to being able to do that is to get that compound interest, be in for the long game, but also being strategically agnostic to be able to know how to make money every time the phone rings, even when the market is trying to punch you in the face, right? Which is what the market is and what Powell is trying to do with us right now until he gets to the end, which for him is going to be that decrease in what he calls a manageable amount of inflation. So that's what we're seeing when it comes specifically to the housing market. And for those of you guys who, and we'll go over in the next segment, all of the different updates for all of the major cities throughout Texas as well.